Investors, we have a huge video today where we will be interviewing Jay Pestrichelli from YieldMax to talk about everything about MSTY and ULTY, two of some of the best ETFs by YieldMax that they have to offer in the stock market. Now in this video, we're going to provide a full and complete review and overview of MSTY and ULTY from the dividends, NAV erosion, dividend projections, how these ETF work, who it's for, the risks, the reward, the pros and the cons, and a full and complete overview of MSTY and ULTY. As always, guys, everybody in our YouTube memberships from our CEO tier, in our YouTube memberships from the ETF Academy, I'll ask some of these questions we're about to ask Jay Pestrichelli from YieldMax. Alright, so basically the ETF Academy is where everybody in our CEO tier gets to ask their questions to both Jay, YieldMax, and so many other ETF issuers on Wall Street about their favorite ETFs and so on and so forth. Our ETF Academy members also get something like a full and complete chapter guide on how to invest in ETFs. You also get your questions answered priority first. You also get exclusive behind the scenes of uncut interviews from your favorite ETF issuers and so on and so forth. It's literally like the best. People love all of our tiers, especially our CEO tier, which will be in the link in the description of this video and in the pinned comment section as well. So I'm going to ask you, Jay, how are you feeling about YieldMax? How are you feeling about MSTY and ULTY and just being on the channel?
Well, I mean, I think they're two unique products in the marketplace, right? You look at, 10, 5, even 3 years ago, nothing like this really even existed. So I love the fact that YieldMax is kind of creating and breaking new ground, creating almost a new asset class. It's something that I think is really interesting and important for people to understand, that because the dynamic and uniqueness of these products, I think is changing the way a lot of investors look at, the way they consider yield and performance, and really actually forces people to have a better understanding of the market. But let's face it, there's some unique aspects of both of those funds. Access to MicroStrategy via MSTY and being able to earn, option premium in the form of a distribution is totally unique. And then when you look at ULTY, I've always thought ULTY is our closest thing to a hedge fund, right? We have choice on what underlying holdings we have. We have every option strategy known to man available us to deploy those tactics on capturing upside and limiting downside. So I think the two of those products are they're some of the most interesting products in the marketplace today from YieldMax, but they're certainly not the most innovative. So the suite, I think we have 50 different funds live today. While those two are certainly top of mind right now, I think there's a lot of aspects around YieldMax that kind of touch all kinds of investors' goals. But yep, feeling that, again, I'm proud of the fact that we're really breaking new ground when it comes to funds like these.
Now, what made YieldMax launch MSTY and ULTY, and why should investors be excited to have exposure to MicroStrategy, which is a leveraged Bitcoin proxy, and also ULTY, which provides weekly income from a more diversified basket of securities?
So what led to the launch of these two funds in particular, because these were not the first two funds that we launched. As your viewers may know, our first two were Tesla and OARC. Those two kind of test the ground here. And what we learned was that while there was interest in kind of all sorts of individual names, we found that there is a certain segment of the market that wants the volatility associated with tickers that could move quite a bit. Volatility isn't always downside. It could be upside volatility, right? And obviously with MicroStrategy, as you mentioned, there is a very strong Bitcoin component to that. And so we know that is obviously a growing trend. But so you want to make sure you have products out there that are interesting to your investors. MSTY certainly has been of interest to our investors for sure. And so having a product like that, it was really kind of a no-brainer. It wasn't in the first swing because of just getting the first round of disclosures out there and first listings. But I think it was in the second, right? The second round of launches that we had, MSTY was part of that. And then ULTY had kind of its own evolution, right? So we realized that, wow, investors are looking for higher yield. Investors like high volatility stocks, but you can't always launch an individual ETF on everything that might be interesting every single day. I'll take GameStop for an example, right? GameStop isn't, well, at some point it might be YieldMax, its own YieldMax. 2.5 years ago, it was a little hard. There's still a little hair on that dog, so to speak, and volatility scared a lot of brokers, scared a lot of individuals. So you don't want to launch a full fund on it, but you can weave it into a portfolio like ULTY that can hold baskets of stocks like that. It can hold a CoreWeave, for example. It can hold a Circle, for example. These are two of the hot stocks. Think how long it would take us to get filed and launched with an individual name. With ULTY, we have that flexibility to go find those high volatility names that produce high distributions from the yield and the options income, and you could immediately put them right into that portfolio. So really, ULTY was one of those like, hey, let's give ourselves a lot of flexibility to find volatile names that maybe we didn't know about, because the filing process and launch process is not overnight, right? It's months. If you're lucky, you get it done in 4 months. So you want to be able to put products out quickly, and a vehicle like ULTY allows you to do that.
I will say to our viewers that I do own MSTY and ULTY. Fun fact. And
great, thanks. It's good you have those.
Can you go over the investment objective of MSTY and ULTY and what these ETFs aim to provide investors? I know some investors are just starting to get into YieldMax because of some of the insane performance some of your guys' products have been having, and the hype, and I guess big community on Reddit.
Yeah, sure. So, and I'm not going to read off the prospectus, but I'll tell you what, I'm going to paraphrase so everybody understands. So the main goal in MSTY's example is using what we call a synthetic covered call strategy to generate income and capture some upside participation of market appreciation. So what does that mean? That means, for anybody that knows what a covered call is, I think most option traders, and even if you're not an option trader, you've heard of a covered call where you're long stock and you sell out of the money calls for premium and income. That's the general gist behind all of the single stock cover call names. However, we're not actually long the stock. We actually don't own in MSTY. We don't own MSTR. We use a combo or a synthetic where we are long a call and short a put, collateralized with treasuries. Those three components together make it feel like you're long stock, right? So there are ETF rules and concentration reasons why you can't just have an ETF that just owns a stock, only owns a stock. So in order to manage through those guidelines, we use options to create that stock exposure. So without getting too nerdy, we use what's called synthetic stock to get long. Then we sell calls and call spreads for that income. So what does that mean, selling a call or a call spread for income? So this is kind of options 101 stuff, but I think it's important for people to understand. The reason we could generate the income and distributions that we do in all of the YieldMax funds is because we're able to sell calls for an amount of premium, and that's tied to the volatility of the stock. The more volatile a stock, the bigger the premium on calls and the more you can sell them for. We use that volatility of the underlying stock to help define what our distribution rate will be. So for example, if you look at, say, an Apple, which has a volatility, an applied volatility of about 20%, we're going to sell options that on an annualized basis will generate 12% of option income, right? When you look at an MSTR, which currently the volatility is around 60, we're going to sell options that allow us to generate distribution around 60%. When MSTR had a 200% volatility, which is really where it was about a year ago when we launched, we were selling options that were generating close to that amount, or maybe we were deciding like, look, 150% is probably enough. Just keep raising the upside strike. Because as a covered call owner, you also have appreciation of the stock price up until where that short strike is. And so let's say, for example, MicroStrategy is trading at 400 and we sell the 415s. The structure itself will participate in all the gains from 400 to 415. And then whatever we sold that call for, let's say it was another $2, we would generate $2 of income on top of that, essentially making 417 or $17 or 417 your ultimate real cap. So that is the way that a covered call works. The added twist that we had put on with YieldMax is then we also buy an out of the money call. So if you get a large run, like you saw in, say, Coinbase recently, or I think Robinhood yesterday even, right? You've got these 10, 11%, 20% up days. You don't want to cap yourself out, right? You still want to make your income first and foremost. But secondly, you want to do all you can to capture the upside. And so having another long call allows you to capture more. So that's more than an overview. I went a little deeper, but like you said, since some folks might be new to YieldMax, cover call spreads using synthetics to generate income, income first, upside capture second. All right, you want to do ULTY? Sounds
Let's
like you had a
go.
question there.
Yep. And I was about to say, like, let's go with ULTY because it's a very interesting fund. And I remember when I made a video titled, like, people either loved that I said ULTY or hated it. But now recently, in the last month, everybody's been crazy about ULTY. I'm not saying I was right, that maybe I was, the timing was perfect with ULTY and appreciating in the share price and having stable NAV, and the dividend's been super solid. So I want to circle back to, what is the goal of ULTY? How does it generate its income, and why ULTY?
Yeah, so the similar goals, the investment objectives of ULTY are to generate income by using option tactics. Generally, we're using collars, but using option tactics that first and foremost generate income and then capture upside of the individual components themselves. The fund is comprised basically of the most volatile stocks we could find that have a healthy enough options market and enough stock liquidity for us to be able to execute the strategy. I think ULTY today is just over 700 million in assets. The fund holds somewhere between 20 to 30 different underlying stocks. And then we run a collar, or maybe we'll use a put spread or a call spread to kind of create the exposure. But the first and foremost goal is generate income, right? We're looking for volatile stocks, and we want to generate income by selling option premium against those volatile stocks. Now, the challenge with ULTY is we're deliberately looking for volatile stocks, right? Most portfolios avoid volatility, right? They don't want volatility. Maybe volatility, some consider volatility to be kryptonite, right? Because, you know, if you go up 10 and down 10, you're in a worse spot than if you had just gone up 5, down 5, or same thing, up 25, down 25. Like, the math works against you. So generally, volatility is to be avoided in portfolios. But with ULTY, we go after the most volatile tickers. We go after what we think are interesting tickers in the marketplace, and we will reduce the volatility as much as we can by actually buying protection, buying puts. We do this all the time around earnings. We don't always do it. We don't always have to do it, but it's just a tactic that we realized, hey, there's no reason to have a single ticker take down the whole rest of the portfolio, right? I remember early days in ULTY before we had the ability to hedge. I think we had a ticker drop 50% in a day on us. Well, guess what? When that's, you know, 20, that's 1/20th of your portfolio, right? That's a 0.5% that just kind of comes off, or let's see, if it's 5%, that's 2%, you know, decline in your portfolio just from one ticker. So we said, let's manage that a little better. Let's risk manage it. We made a change to the prospectus, gave ourselves the ability to run multiple tactics as long as it's first and foremost about income and upside capture.
I'm just going to jump on to one of my later questions, but so ULTY saw some, I guess, NAV decline, right? Just share price only, not including income since inception. I don't know, it was like $30, then it went down to $5. Now it's going up and up and up, which is very interesting because this is a high income product, a lot of volatile names. I don't know if it's because of the bull market we're seeing recently, or a lot of investors want to know if those strategies were changed, because ULTY now, I guess, is becoming one of the more popular YieldMax ETFs, and I could see it reach $1 billion very, very soon just because of the active management that YieldMax is doing. And from what you're saying, hedging different strategies and tactics. So can you explain when this strategy was implemented and what investors could see in the future for ULTY? Because not only are YieldMax investors buying MSTY, but they're also buying ULTY.
So the first point you mentioned was right, that the NAV had declined. So there are two components when it comes to the returns of any YieldMax ETF, any ETF period, actually, right? So the first component is you've got, remember, we're long stock, right? Yes, we may be running a collar or a cover call strategy. First and foremost, you're long stock. So when the underlyings move up and down, so will your portfolio, right? So you have the returns of the underlying, and then you've got the returns of the option tactic. Those two returns together end up providing the total return. I took a little exception with one thing that you said when you said, well, the NAV has moved minus income. You can't minus the dividends, right? That's the whole strategy, right? You can't exclude that ULTY dividend, right? Because that's the attraction, and it's our primary investment strategy, right? I was deliberate to call that out. So when we look at the total returns of ULTY, which ultimately is not play on words, ultimately how an investor should assess what they're invested in is not necessarily what the NAV is or what the dividends are. It should be the total return, the total package. And this is one of those things about some education that I think investors should be aware of. I love doing videos like this, Marcos, because now all of a sudden I can, it's another channel for me to get the message out. Look at total returns. That should be your judgment if this is a good or a bad investment, or if it's meeting your investment goals. The way those returns can come, whether it's appreciation or distribution, it shouldn't matter. It should be the total return package. However, everybody knows you look at a stock chart. I get it. You throw in an ETF and you look at something, you go, ugh, look at that. That doesn't look so great. I thought MicroStrategy was way up for the year. And then you look at the total returns, you go, oh, it's up over 100% for the year. That's interesting, right? So it's one of those things that total return should be what you look at. So not a lot of folks have the ability to or know how to look at total returns, right? So we have to get better tools at our brokerage firms and whatnot. But there are different ways to assess that, right? Look at Yahoo Finance, look at the adjusted price. That's the cheapest because it's free, or easiest way to look at on the day you bought versus the day it's trading now, what your real cost basis is, considering dividends, right? Things like that matter. So back to the ULTY question. ULTY has leveled. The market has been on a very nice run, a bull run. A lot of the tickers in the ULTY portfolio have appreciated. Now, it's not because we're just amazing stock pickers. Again, we are screening for volatility, option bandwidth, underlying volume, right? Sector diversification. I think all of those things come into play. ULTY is not single stock risk. ULTY is diversified, right? I mean, there are a lot of different holdings across a lot of different sectors, whether it's energy or software or semiconductors, right? Like there's a lot of stuff that goes into that portfolio. So I think the diversification, I think the performance, which you are equating to NAV stability, which I agree has been there, but that could go like in a bear market, that can turn, but you could still have those distributions on top of it. Right. So I think it's all of those factors. And I think the weekly piece is a part of it too, right? Having weekly distributions. Some folks really like to get that weekly paycheck and they get to reinvest their dividends, which I want to talk about in a minute at a faster rate than if we held them in the fund for, say, a 4-week period or a month, like some of the other YieldMax products. Look, I think there's a little bit of the fact that we can move fairly quickly between popular issuers or popular stocks when something's happening, right? We were in Circle the minute there were options on Circle, right? So it's fast. So you want to get some exposure to that world? Great. You could get it right away. So I think those are all of the aspects when it comes to ULTY's popularity.
I did like what you said to look at total returns. I think that's one thing I try to, ingrain in my viewers is you look at Google charts or like whatever you go on Google, Robinhood, etc., and it only shows the share price drop. So it doesn't factor in dividends, which are, or should I say, premiums, income, that are the most important thing to look at with these strategies, especially with YieldMax. And I guess sometimes you could see some good growth in the underlying because, for example, strategy back in the day, running up, we're seeing HOOY, we're seeing PLTY coming up with some good growth, not including the dividend, or should I say the income. A big topic is sustainability, especially from an income standpoint. So if we look at MSTY, back in the day, we saw $4 dividend a month, $3 dividend, then it was $2. Now we're in the mid $1 range for dividends on MSTY. And I'm seeing so many investors search up on Google MSTY dividend prediction, MSTY dividend projection. So I'm seeing so many investors, YouTubers trying to predict the next MSTY dividend or the future of the MSTY dividend because they do have a significant amount of money invested in MSTY for. Now I'm going to ask you, what do you think the future holds for the MSTY dividend long term since MSTR is at, in my opinion, I think an all-time low for volatility? So I'm going to throw it back to you. MSTY dividend
Yeah, I mean
right now.
that's so you nailed it, right? Like that's the distribution rate is absolutely correlated to the implied volatility of the underlying ticker, right? Right now, MSTR is experienced the lowest implied volatility since we launched MSTY, right? So if you look back and you look at a chart of the implied volatility, it's never been lower. So what does that mean? It means the dividend has to come down. The distribution has to come down because there's less option premium to sell for, right? I mentioned Apple before because Apple's had a fairly stable implied volatility in the 20 to 30 range. I don't even know if it got over 30 during the Liberation Day market volatility. So in those scenarios, it's like we'll never get 100% distribution out of Apple, right? You just can't unless you're taking leverage, right? So, which we don't do. So I think it's important to recognize that if you want to know where the distributions of MSTY are going to go, you need to tell me where's the implied volatility of MicroStrategy going to go. Now, I think there's probably a fair correlation between the volatility of Bitcoin and the volatility of MicroStrategy, right? You mentioned that before. Let's face it, their whole company owns a bunch of Bitcoin or notes associated with Bitcoin, right? Like that's their business model now. And that's how Michael Saylor wants it, which, by the way, he knows of MSTY. He pays attention to MSTY. He likes the fact that we're harvesting volatility out of it and distributing income where he is not able to do that in his stock, right? So it's one of those things that he understands it. And so to help the people that are trying to predict volatility, I would say predict the volatility of Bitcoin, and you're going to have a clue into the distribution rate of MSTY.
So for investors who might be, I guess, let's say MSTR has lower volatility, so we might see a lower income for MSTY. Would it be wise for them to pair MSTY with ULTY?
Well, again, it depends what their goal is, right? There are other tickers that have higher distribution rates in YieldMax than MSTY. You can go to anything, right? Now, we actually have a crypto-focused YieldMax, LFGY. It just holds crypto companies or crypto-associated underlying long stock. It's also diversified like ULTY, but it has a mandate to stay within the crypto and blockchain world. So if you're like, well, by the way, obviously MicroStrategy is in LFGY. Well, I want, a little more yield. You could look there. It doesn't always have more yield, right? At times because it's a mixed basket. I think it's like a 65%. That also has a weekly distribution like ULTY. You could pair it with ULTY if you wanted a little higher distribution rate and you wanted to have higher, like a more diversified portfolio. Yes, of course you can do that. But again, it's not the highest yield, right, that we have. So if it was only about finding more yield, there are higher underlying tickers. And the way to figure out which ones will be higher is look at the implied volatility, right? Look at any option chain and they'll give you the implied volatility. Heck, you could even chart it sometimes, right? You could throw up a chart and show up the 30-day IV. That also will be helpful. So, I mean, we are really clear on what our target for selling options is, right? It has to do with the implied volatility of each one of the weeks that we're selling options for. So not a lot of mystery there, but you have other choices. Again, hard to know what anybody's goals are. I mean, why not just be all ULTY if it's all about getting more? Because MicroStrategy is in ULTY, right? It's always going to be in there. Or you could do some ULTY and LFGY. Like it all depends what you're trying to achieve. I think those are all interesting. Look, this is the beauty of the YieldMax suite. It's not one product. It's not two funds. It's not 10. It's 50 funds, right? You have a lot of different options, pun intended, on what you want to choose when it comes to YieldMax.
We'll throw it back to ULTY. So once again, how sustainable is the weekly income supposed to be? I know you're probably going to say, depending on the volatility, right? But ULTY has that great strategy of choosing highly implied volatility names, active management. I've seen on Reddit people say, oh, they try to pick stocks based on earnings, or they try to pick names before the earnings come out, after earnings come out. I don't know how often you guys switch the holdings, right?
Sure.
I know you guys have Robinhood, whether there's Upstart, Tesla, Strategy, Reddit, etc. So how sustainable is the income going to be moving forward? I know before ULTY switched from monthly to weekly, the distributions were dropping month for month. But then when it went weekly, it's been like stable. So I
Yeah,
let people
I
love
think
ulti.
that's just happens to be the timing of when the market also stabilized, right? So I wouldn't read into actually weekly is a little harder because I have to come up with cash, right, more often. Whereas when you had a four-week period or a monthly period, I could be invested a little longer and maybe sell a little more premium, right? So, but that's okay. We know that there's the benefit here of the weekly. It is a little, maybe it hits it at 1%, right? We have 1% less invested, that kind of a thing. But we'll always look for volatility. I love that you brought up the earnings component. We will put positions on for stocks that have earnings coming up in the next few days because why? Because volatility's up, right? Like it's not necessarily a call on like obviously with the positions we put on, we want them to go up. Like we want to pick a stock and it blow through our short call because it means we got the direction right and we made our premium. But it doesn't always happen, right? There's plenty of times where that long put saves us, right? We had Restoration Hardware. It got smoked this past month. However, we also had Nike last week. It beat earnings, went through our calls, right? So we're going where there's volatility. That's more of the mandate. And putting on that collar will reduce the risk, but also help us earn that extra income because of the higher volatility. So yes, we'll definitely do that. Can Ulti's distribution rate be sustained? You're right. It has to do with volatility of the market. I don't think volatility is done for the year. Yes, it's a little bit lower now than where it was, say, 2 months ago. There's still plenty of news coming in this news-driven market. Usually when you're at all-time highs, let's just use the VIX as an example, right? The volatility index. Let's use that because we're talking about volatility. The volatility index, the VIX, typically is in like 14, 13, 12, 11 range. Last I saw, we just hit all-time highs yesterday. Last I saw, we were at 17, 18 on the VIX. So vol is high across the board. I think there's still a lot of market-moving headlines and news to come over the next 30 days. So that's always going to be the case. So yeah, so there's earnings every quarter, 4 times a quarter for stocks. Okay, I can find vol that way. There are new names that come out, right, that you have the ability to capture their volatility. We're not big fans of kind of catching falling knives and looking at stocks that are in a catastrophic sell-off, but eventually those things level out and there's volatility in those things, right? So, it's one of those things I think we'll always be able to find volatility. I can't predict that the distribution on Ulti won't drop below the 80, 85, 90% level. It might drop to 70, but I think we'll always be able to find names that have an implied volatility of 60, 70, 80.
Is there a best and or worst case scenario for MSTY or ULTY? It's kind of a broad question. I know a lot of people have hundreds of thousands, if not millions, invested in MSTY or ULTY, or some of them are selling other names. I'm not going to say tickers. I'm not going to say companies, but they're selling other names that they used to have for decades. And then when they found out about YieldMax, they might have been skeptical at first, and then they're like, oh no, they're the real deal. So now they're selling out of their names, taking out loans, margin, investing a lot of money in MSTY and ULTY. So people want to know, is there a best case scenario for MSTY or ULTY from an income, long-term projection standpoint, and or a worst case scenario? Because people on, I guess, X or Reddit, flexing the dividends, flexing their gains, right? Some of them are having 100% total returns. And some people are like, oh man, I'm so late. Is it too late for me to get into MSTY or ULTY? And they want to know, is there a best case scenario and what's the worst case scenario for these funds?
Absolutely there are, right? So these are covered calls and they're collars, right? Those are bullish underlying biased option tactics. So what's the best case scenario for MSTY? And some people, this may not hit home right away. We want it to go up, right? Owners of MSTY are bullish MicroStrategy. So you want MicroStrategy to go up. Do I care if MicroStrategy just goes right to my strike and doesn't go any higher? Actually, I'd rather it blows through it. Go. It's okay. But again, if our goal is income first and upside capture second, I want to hit my cover call strike. I want to be able to sell. So I want volatility in the name to be able to generate that premium. And then secondly, I want upside capture. Now, yes, maybe we may be capped for a period of time with some of the position and the upside capture, but we have long calls because we use this call spread. We want it to go. I got to tell you, ever regret if MicroStrategy is up 12% and MSTY is up 6, do you feel like you could have captured more in MSTR? Sure, but my goal is not to be long MSTR. Otherwise, I just would have owned MSTR. My goal is income first, that premium, and then the upside. I love making 6%. Like, that's great, 6% gain, right? Better than like, oh, but you picked it right to the strike and you made 2.5. I'd rather make 6. So upside movement, any cover call strategy is desired, especially the way we do it at YieldMax with spreads. But more importantly is the worst case scenario, right? And I probably talk more about this than anybody else. You are long the stock. You are long MicroStrategy risk. We talked about you're long Bitcoin risk, right? So you don't want MicroStrategy to go down, right? If you're bearish MicroStrategy, then MSTY is the wrong position for you. You should buy the inverse, which is winter, WNTR, because we do have some inverses, right? When I talk about some of the innovative products out there, having an inverse on MSTY is important, right? Have winter, right? It's the same thing. It's a covered put instead of a covered call. It's bearish with selling puts instead of selling calls. But we don't, I know you don't want to get into that one too much, but I think it's worth talking about it in the same breath because we give people the option based on their bullish or bearish. So worst case scenario for MSTY is if MicroStrategy tomorrow is down 25%, MSTY will be down 23%, right? Yes, you lost a little less, but nobody's feeling good about losing 23%, right? That doesn't feel good. So I think it's important that people recognize that you're taking single stock risk when you're using a single stock ETF like MSTY, right? You're taking idiosyncratic risk. I don't even want to say all the ways that could go wrong. I don't want to scare anybody out of it, but you just need to be considerate of that, right? As an advisor, right? I don't mind having your one-offs, taking your shots, right? But I would never put half my portfolio in one ticker like MSTY. That's just not my risk tolerance. I don't want that, right? And even if I'm bullish Bitcoin over the long term, man, single stock risk is a lot. There's a lot of things that can go wrong that have nothing to do with Bitcoin within that company, right? So I think, you mentioned people like taking loans on their houses, like still, I'm certainly not recommending that. I think be careful, just like anything. Understand the risk that you're taking. I've heard the argument, well, aren't I going to make it all back? Like, hey, if I'm paying 8% on a HELOC, why don't I just do that and then just pay it back with MSTY distributions? If you do that, you are in the hope business and you're hoping that MicroStrategy doesn't go down 50%, right? So that just realize what your perspective is. Could that happen? Absolutely. It could happen. It hasn't happened yet. But could it also be that they're right, that the distributions will pay for that loan? Yep. That also could happen, right? Don't know. It's all about the performance of the underlying, which ultimately is bullish.
We'll talk about the investor profile that's right for MSTY and ULTY. Is it, higher risk investor, younger investor, older investors, somebody who's about to retire, is retired? Is it somebody who knows how cover calls work, how these products work, and that's super hands-on? I know some people are buying MSTY, hedging with winter, buying ULTY, throwing it in with, S&P 500, NASDAQ 100 names. For you, what is the investor profile that's suitable for MSTY and ULTY?
Yeah, you said a lot of them just now, right? So you have to have stock type risk. So you have to be comfortable with that level of risk, right? Generally, stocks are considered to be a risk asset, right? Because we saw what happened in April, right? A 20% decline in 6 weeks, right? That can happen quickly. Think about the pandemic. 35% decline in 3.5 weeks. Like, these things are like fast, right? So you have to be comfortable with equity risk first and foremost. You should be looking for alternative income, right? It's not all about growth, right? These are income generating products. This is for someone who wants alternative income. Option premium selling falls into the alternative income category, right? It's not stocks, it's not bonds, it's not cash. If it's not those three things, it's an alternative. So option premium, option tactics are alternatives. So, if I was looking at the pie of a pie chart of investing, and you had an alternative sleeve, these would fall into the more aggressive allocation to the alternative sleeve. These days, investors should have 20% allocated to alternatives. By the way, that could include gold. It could include oil, but it also could include options-based strategies. And so, yes, you would put this into your alternative category. Does somebody need to understand cover calls. I think you should know what you're invested in. But if you really knew cover calls and you don't need us and you could do it yourself, or maybe you don't want to do it, that's fine. Then you have us do it in the funds. But we think we're bringing this concept to the masses in a vehicle that's easy to buy, like an ETF, and they can buy it. I usually say put it on a drip, I mean dividend reinvest, and then you don't have to worry too much. These can be investing vehicles. There's no doubt about it. These are not like leverage funds or futures-based funds that have a natural decay in them. That's not the case. You can hold these, again, just in the proper allocation. So you said retired. Sure. I think retirees should have an allocation to alternative income. Absolutely. If you're young, sure. No problem. I definitely recommend you do a drip if you're young, right? If you've got time on your side, you should be trying to compound your shares as much as possible. I know a handful of folks that are, children of clients that are in their, early 20s, mid 20s, late 20s, and they love getting into the YieldMax products because they like to see the size compounding. They see the dividends. They like ULTY. They like YMAX. They like the weeklies. They get the weekly payment. And they see their shares getting compounded because they're reinvesting them because they don't need the cash, right? They're in growth mode. So I think all of those, hopefully all of that makes sense. As an advisor, these are great vehicles when you've built an income portfolio, right? So if ULTY is 5% of your portfolio, you've now just taken the distribution for the whole thing. Let's just say ULTY's paying 80% on average. Depends. It usually pays more, but let's just say it's 80, right? And if that is 10% or 5% of your portfolio, you just created a 4% increase in your portfolio's yield, right? So you may have bonds, that's typical yield stuff. You might have some high yield, right? But you throw some alternative income stuff in there, then all of a sudden you can give this kicker. And by the way, they're probably also doing a dividend reinvestment and doing a regular reallocation. So it allows you constantly to be able to put money into maybe a position that's down. You get to buy more. Love dollar cost averaging across the portfolio with the distributions from ULTY or a YMAX. So there's use cases really across the board when it comes to these.
Why is MSTY monthly and not weekly? And will it ever go to weekly income?
MSTY is actually not monthly. No, MSTY is every 4 weeks.
Oh, really?
So we have 13 distributions, not 12. So why do I call that distinction? No, it did not. Let's not break news like that right now. No, MSTY is every 4 weeks. So what we realized is because people wanted to get weekly payments, we created 4 groups of YieldMax single stock ETFs, and that rotates, right? Every week, one of the groups pays a 4-week distribution, right? The next week, so we have group A, B, C, D, real original names that we have. But, group A pays, then group B pays on the most previous 4 weeks. Group C then pays the next week on the most 4. So the reason we organized it this way is because for people that held multiple positions, multiple YieldMaxes, they could get a weekly distribution in each one of their different holdings. And so you end up having 13 distributions, right? 13 times 4 is 52. So this is just one of those things that we thought, because we know we had people asking, but it doesn't always make sense. It's hard to run the single stock strategy with the way we're active on the covered call and covered call spreads to have these distributions occur weekly, because I'd have to constantly be getting out of positions that hadn't made all their money yet, right? So we need the time to decay. Like, let's take, for example, this week, right? We're recording this the week of 4th of July, right? So we have Thursday is a half day, Friday's a day off. I've only got 3.5 days this week of trading, right? So guess what that means? Your option income will be lower, right? So imagine if you held the ones like, oh, great, here comes, Monday the 7th after the 4th of July weekend, and you're going to get like, boop, through, 3.5 of what you'd normally expect, right? So spreading that out made a lot more sense. The more time we could be in it, the better.
Some people want to know, will there be any changes in strategy, like with ULTY, in terms of the hedging to, I guess, make the NAV more stable with their single stock names like MSTY and other names? A lot of people on Reddit ask me that, so I'm going to ask you that question.
Sure. Again, let's go through the prioritization of the fund, right? First is income. Second is growth, right? I haven't said NAV preservation yet, right? Third, let's throw in is NAV preservation, right? So it's not one of the 2 top priorities for that fund. I get it. People want to see it, and I appreciate that. Of course, I'd like the NAV to go up and be stable as well. Can't always control that. I can't control that at the cost of the primary investment objectives of income and growth.
So with MSTY, we have a hedging opportunity with Winter, ticker symbol WNTR. Some people want to know, is there a hedging ETF that you like by YieldMax to hedge against ULTY, or is ULTY, built in the fund to hedge against its underlying names?
Yeah. Yes. So this is interesting, right? Because we have these volatile names, right, in ULTY, and we're still hedging them. So we end up having the volatility of about the NASDAQ, right? So we have the vol of the NASDAQ generally in ULTY, and returns similar. Like I'm looking, it looks like year to date, ULTY slightly outperforming the Qs. But what I would say is you can use the inverse of the Qs, YQQQ. There is a YieldMax they treat the NASDAQ as the underlying index, and we, sell put spreads just like we do with Winter. So if you wanted to create an offset, and I'm careful about using the term hedge when it comes to Winter or YQQQ, because they're not perfect hedges. They will definitely reduce the volatility in the portfolio. You have offsetting moves. When ULTY is down, YQQ is up. Yes, I get all that. They're just not always perfect hedges because there are limits, right? If the market rockets up, YQQQ can lose money more than ULTY can make, but ULTY typically isn't capped, but it could be. But on the way down, same thing. ULTY is going to have some limitations, but YQQ will make money in that scenario. So look, I think that's a really good pairing of YQQQ and ULTY together.
Now, can you describe how MSTY and ULTY move in the share price before, during, and after the dividend is distributed? Because everybody I'm seeing is studying these charts like they're glued to the charts and saying, oh, the NAV dropped, but then when you got the dividend, you see that the price moved up. So you're getting the distribution and then you're getting the upside. And I just want to ask you, can you describe, or is it even a big deal on how the share price moves before, maybe let's say, a couple of days before, during when the dividend is given, and after the dividend or income is distributed by MSTY and ULTY?
Okay. So ULTY's got so many moving parts. Let's leave that one to the side. Let's start with the single version of MSTY. And actually, I'll use just a random number anyway to kind of help understand. So let's just say we already talked about that the underlying market has an impact because we're long the stock, right? So there's two components to the performance of any single stock YieldMax. It's market movement of this ticker and then performance of the option strategy together. Okay. So let's just take out the movement of the underlying ticker because I think you want to know about the dynamics of the distribution, right? So let's just say we had a stock at $100, right? And the ETF, the single stock ETF, was also at $100, right? Stock stays at $100. We're selling the 105s for $1, right? For 4 weeks in a row. What'll happen is the ETF will sell the call for $1 and it'll earn that premium of $1. Remember, the underlying is not moving. It'll go from 100 to 101. Then we sell for $1 the next week. It'll go from 101 to 102, right? And so on and so on. And so now we've got 4 weeks in and we've sold for $4. The underlying hasn't moved, but we're net positive $4 of option premium. So the ETF has gone up to 104. Now we turn around and we have a distribution of what we made from selling option premium, which is $4. The stock declares the dividend on a Wednesday morning. We declare the dividend. On Thursday in your account, the ETF goes from 104 down to 100, and you also now have $4 of cash in your account. Together, you have 104. That's the total return, by the way, in that scenario, 4%. So it's not, so you went up from 100 to 104, distributed down back to 100. That's the simplest example I could give you. What happens in the days leading up to a distribution is completely dependent on the underlying movement, right? So in my example, if the underlying stock went from 100 to 90, my 104 would go from 104 to 94, right? So everything went down 10, each went down 10. We still would distribute $4 because that's what we made in the time premium. Now you'd be left with an ETF at 90 and $4 in your pocket. Some may say, well, look, your NAV went down, right? Yeah, NAV went down because the underlying went down, right? That's a huge component of the movement of the underlying stock. By the way, the inverse works the other way. Stocks continue to go up, 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 right? You can have appreciation. You can write it from 100 to 110 in that scenario. Maybe you get 114, right, would be your value. We distribute $4 down to 110. That's the way ex-dividend works for the history of ex-dividends in the stock market, right? This is nothing new that's happening here. But the distributions are so large, right? What was our hood distribution last? I think it was like a $6 dividend, right? It was humongous, right? So, but as a percentage, it made sense compared to the price of the underlying ETF. That's all okay, right? But it looks weird on a chart. It looks like, oh, they were down $6 today. Nope, not at all. Could have been flat, right? It's just the distribution and the way dividends work. X date is when that is effective and you get the cash. You may not get the cash till like a day later in your account. I think the pay date is usually Friday, right? So announce Wednesday, go X Thursday, payment on Friday. By the way, that payment on Friday being one day after X is very unusual. Many ETFs will make you wait weeks. Sometimes stocks will make you wait a month. We distribute it right away because we know our investors are looking to reinvest the dividend, right? So we don't want to hold it. We send it out, which is a little extra work on YieldMax and their administrator title, their side to do that. But we know it's what's important to investors.
You said that you like automatically dripping the dividends, the income from an ETF. Some people either drip automatically right when MSTY and ULTY pay the dividend or income. Some people take that income, use it to fuel other positions, maybe other cover call products by other competitor names, maybe even other YieldMax names that they like, that they feel high conviction on. Or maybe some of them I've been seeing take the income, wait for, I guess, the underlying to drop in value to get maybe a steal, better opportunity, and then they use the income, drip it then. Some of them use that income for their own needs and then leave the other half on the table to drip back into the ETF like MSTY or ULTY. So what are your thoughts on, I guess, the best way to approach how to go about reinvesting the income?
Okay, so you gave a lot of different examples there, and they are all legitimate and all depends on your flavor of what you're trying to do. But realize when you're not reinvesting the distributions back into ULTY or into MSTY, you are in essence divesting to cash. You're letting that cash come off. You're letting it being pulled out of the ETF, which we know we're doing. We're giving it to investors. We know this. We're paying it to investors. We deliberately are paying all of the premium we're earning. A lot of funds don't do this. We're deliberately doing that because we want to give investors the choice on how to utilize that cash. Like that cash is a vehicle. It's a tool to be utilized. So you want to reinvest back into MSTY. You're now compounding your MSTY shares and you're experiencing the total return of MSTY, which includes the reinvestment. Because if we never paid a distribution and kept it all, we'd be the ones doing the dividend reinvestments for you, right, as an investor. But we pay it out. So if you want really what I would call the most aggressive growth approach to a MSTY, still its alternative income is what's driving a lot of that return. Remember, stock return, option return, those are the things that drive returns. The options are driving a lot of the return. Now you're just using that as your aggressive piece. If you want to take it and diversify into another asset, it's fine. It's like if you owned NVIDIA and as NVIDIA hit an all-time high, you turn around and be like, oh, I'm going to take 10% off of NVIDIA and I'm going to sprinkle it into the other Mag 7. It's the same thing just like if you're not reinvesting the distributions back into MSTY, you're just choosing how else to allocate it. And then there's some people that go, I want to live off of it, right? That's my income. I want to take that. The challenge with that is it's almost as if you were pulling 5 or 10% a month out of your portfolio, right? You have to hope there's appreciation that offsets that, right? Like if you just own stocks and you're like, I'm going to live off, let's just say, 8% a month, which is 100% a year, right? You're going to run out of money fairly quickly, right? In that scenario, there's not a lot of things that make 100% a year to offset that kind of withdrawal, right? You're digging into the principal. Same thing with the YieldMax ETFs. If you're not reinvesting them, you're choosing to pull it out and doing something else without it. I think a lot of folks just forget that because they see, wow, look at this yield, 50%, 100%. I'm getting all my money back in a year and I'm fine. That may be true, but there's a really good chance the NAV is lower from those distributions, right? The underlying stock would have to appreciate to help offset. Now, it doesn't always have to do that, right? We will be additive. YieldMax can be additive to total returns through the premium selling tactic. Of course, we hope it's additive. It's meant to be additive. So yes, there can be some outperformance, but generally with covered calls, you don't get outperformance because you've decided to sacrifice upside for income. Remember I told you about that cap? Now we do that call spread thing so we capture some more upside when a stock moves. But, there are times where you'll have distributions essentially made your option premium in that example I gave you and didn't get any additional upside because the stock hasn't moved. If you continued to do that, you would then, you just have to recognize what you're doing when I say divesting to cash. You're choosing to, if you're pulling that cash out, you need appreciation of the underlying and really the underlying ETF to make all that back. If we only distributed half, and we've been asked this many, many times, just what if you distributed less and kept the NAV stable? My response to them is we always want to distribute the premium we made from options. If you wanted to keep the NAV stable, reinvest it. Your balance will maintain stable. Who cares about the price of the ETF? Your balance maintains stability. That's ultimately what's more important when it comes to a portfolio allocation.
I had a question that someone said, is it too late for me to invest in MSTY and ULTY because MSTY had some of the best performance I've seen from a cover call ETF on a single stock name recently, since inception. And then ULTY's coming with some great performance in the last month, outperforming MSTY. And so is it too late to invest in these products for somebody who wants to get in? In my opinion, I'm going to just throw it out there that I don't think it is because of these new strategies and tactics that you guys are doing to capture, I guess more upside and the hedging of ULTY and the new strategies being implemented. I was talking to another YouTuber, Spencer Invest, and saying like, hey, I think YieldMax is doing great because they could sit on all this AUM and just let the funds do their thing. But I was telling him like, no, YieldMax is actively trying to establish themselves, in my opinion, as the high income issuer. Kind of circle back onto, is it too late for somebody to invest in MSTY and ULTY?
Let's take MSTY first. Remember, you should have a bullish outlook on MSTR if you're going to buy MSTY. If you think MSTR has more appreciation ahead of it, then it's not too late, right? If you think MSTR is done with its run, then okay, then at that point you're in it only for the premium and you just have to make an investment decision or have a bias on is it bullish or bearish. You could do the whole winter plus MSTY thing if you wanted to, right? To kind of like, I'm in it for the dividends and I don't want the volatility. But that's why you have that alternative, right? If you think MSTR is overblown its run and you think it's capped out for a while, winter is there as your choice. But really, it's your theory on MicroStrategy, on MSTR, that should be driving that decision. So if you think there's growth in MicroStrategy, MSTY is poised to increase. I'm not guaranteeing anything, but let's face it. If MicroStrategy goes up, MSTY is going to go up. That's just the dynamic of the build. ULTY, more of an index question, right? We've been liking ULTY to QQQ here. I'm a believer of long-term investing. I love the Qs as an investment decision. I never think it's too late to buy the Qs in your life. So by saying that, I feel like you've never missed the ULTY run, especially that we know will continue to find volatility in the marketplace, right? So again, the market timing here on these is just dependent. If you're bullish the market, ULTY should perform fine. But look, we could just be really bad stock pickers and pick 27 bad stocks. That would be really hard to do, just as hard as picking 27 good stocks. Actually, in this market, it's harder to pick 27 bad stocks. But let's just say we did. That's the risk you take, but you do know we are managing some of that risk with some protection. So there's a little bit of you're betting on the market being bullish. You're taking a risk that our stock selection is going well, and you're taking the risk that volatility is going to be there for the distributions to continue.
A lot of investors are having some of the highest income they've ever seen in their entire life. Tax implication is return of capital. I'm not gonna lie, when I first saw return of capital, I thought it was just the fund giving back the capital from the NAV. But now that I've been hearing other ETF issuers, CEOs, there's a reason why the income is classified as return of capital. My question is, can you explain what return of capital is and why it's beneficial to classify the income as return of capital? Because so many people have been telling me that they love that YieldMax is classifying the income as return of capital.
Yeah, so this is an interesting topic right now. Look, a return of capital is a tax classification of the distributions, right? I've heard a lot of folks say, oh, they're just giving your money back. And I think in the past, if an ETF or a mutual fund had return of capital, it's really what it was, right? You would, let's say I was in a portfolio of bonds that paid 6%, but I got paid out 10%. 4% of that had to come from somewhere. It's either appreciation or you got your money back. But that's not the case when it comes to YieldMax funds. Return of capital is the trigger for something to be considered return of capital is when you have paid a distribution, yet your realized, the important word, realized gains and losses were actually negative. So from a realized perspective, the fund looks to have lost money, but yet it still made a distribution, right? How can that be? Well, it's actually very simple, and it happens all the time in options-based strategies, right? One of the oldest cover call strategies that have been out there, longest running, is QYLD, 13, 14, $15 billion fund. 90+% of their distributions are return of capital. If you look back through their 1099s and look back through the 19As, it's all return of capital. They're not giving you back your money, right? What's happening is the income that's being generated from options might be from a losing transaction, right? Yet the fund can make money. Let me give you an example. Have a step back to my stock at 100, right? Stock's at 100. I sell the 105s for $1. The stock runs to 110, right? Now it's time for me to get out of those 105s. I need to pay back $5 to get out of that call, right? So sold it for $1, pay back for $5. Net loss on that transaction is $4, right? Nothing hard there. So if I still paid the dollar out, if the fund still pays the dollar distribution, right, that's return of capital. But the underlying stock went up, and you made that time decay, right? It wasn't a $5 loss. It was only a $4 loss on the on the $5 move. So from a tax perspective, return of capital, because there was a loss in that trade. But ultimately, the fund actually made money. You made money, right? And you made the time value as an investor. So but it's the tax classification. That's all it is. So look, it's for folks that are, I'm going to accuse people of saying this, being lazy and just saying return of capital means you're just getting your money back. It's absolutely not true. Look, there may be times where at the end of the year that because we do distributions every 4 weeks and the fund does lose money, that, yeah, ultimately it was return of capital and you did get back your money. Even though you earned time premium along the way, the fund can be down and you still get these distributions. It doesn't necessarily mean you've been just given back your money. Like, let's say, for example, IBM pays a 1% dividend every 4 quarters, right? Each quarter you get 1%. Well, if IBM's down 30%, that you don't feel like, that 1% distribution, they just gave me back my money. That's not true. Nobody thinks that way. It's the same thing here. But the returns that are driving the distribution come from earning time decay, earning cover calls being sold at $1 in time value and going to 0 in time value, regardless of the intrinsic value of the call when we had to cover it back. So, yeah, it's a misnomer. It's okay. We probably err on the side of being conservative and tell people, here's what we think the return of capital is. You don't really know, by the way, to the end of the fiscal year. Like, you don't know. You got to have all the gains and all the losses. And then if at that point the income you made, because the fund lost money, gets classified as return of capital, so be it. There's actually an advantage to your income being classified as return of capital, right? You're not going to pay taxes on that, right? You will pay taxes. Eventually, it'll lower your cost basis. So when you sell the ETF, If it's still higher than when you bought it, you'll have capital gains. And if you hold that for a year, it's long-term capital gains, which is less. But on that distribution, in that example, you won't pay income tax on that. Like it won't get classified from a tax perspective. So I actually think it's a good thing, right? But that's okay. I know there's some negative connotation. This all goes into understanding what this kind of, new asset class that I'm talking about is being defined, whether it's understanding a total return, understanding the dynamics of return of capital. This takes some level of education, which is why, Marcus, I love, doing these kind of videos. We get it out there. Let's talk about the things that people just have a misunderstanding about.
Now, give me two of your favorite YieldMax ETFs not named MSTY. So let's go with single names for MSTY. And then two diversified, I guess, index-based ETFs not named ULTY.
I'm not going to pick favorites at all because I'm not. Look, let's go back to what I like the best, right? Like we want stocks that go up as the underlying. So you look at Hui, the one on Hood, or you look at Carvana. Heck, look at Netflix. It's one of the longest running yield maxes we have. Total return on that's great. Again, it's total return is what I'm looking for. I want underlying stocks that are going to appreciate. Yeah, like Carvana's been really interesting. Palantir's been really interesting. Like these are great names to consider. You want to pick you tell me which stock's going to go up. That's my favorite YieldMax.
Long term, right? This is a new space. You guys are the pioneers, in my opinion, in the single stock high income space, and now establishing yourselves as the go-to cover call ETF brand for high income. And you guys are seeing, I believe, almost 15 billion AUM. Is that correct, or am I off?
Nope. You're close. I'm going to look at what it is as we're recording this. It's just under 15. You're correct.
What do you think is the long-term, I guess, goals and long-term projections for YieldMax in the next 5, 10, 15, 20 years? Because let's say, 10 years ago, 20 years ago, there was no cover call ETF. There was QYLD, and then there was JEP-B, JEP-Q, and now there's, other products and other ETF issuers, and now we're seeing single stock names with super high yields, and people didn't believe in it. CFAs and portfolio managers were like, stay away from it. And then a year later, now we're today in this video, and we're in this new time, and people are saying, well, if you're bullish on Robinhood, if you're bullish on Palantir, then I don't see why you shouldn't own a YieldMax ETF that has income, because you could get a better return than the S&P. If the S&P goes up 10, Robinhood goes up 50, HOOY could go up, 35. So you're beating the S&P. So the question is, I guess, how is YieldMax branding themselves long term? What's your guys' goals long term for your guys' products?
Yeah. So look, I think we'll continue to have exposure to more and more single stocks because we want to have exposure to interesting names where we can harvest yield. It's interesting. You mentioned a really good point. Hey, if you're bullish a stock, be in it because it could outperform the index. We don't have a screener when we choose our tickers that tells us these stocks are going to go up, so pick these. Because, like I just told you, it could take 4 months to get a fund out, and the universe can change completely for any ticker in 4 months. Just ask Elon Musk. So what I would tell you is that we will continue to put out more single stocks that we think are interesting, that we think have volatility and have all the characteristics that could sustain a meaty ETF. We'll continue to be innovative, right? We don't just have the single stocks or the ulties, right? We talked about YMAX, which is a fund of fund, which I didn't get to tell you is probably besides ulti, one of my more preferred and recommended tickers for a diversified portfolio, right? There's 36 names in it, and it's all of the bullish yield maxes, maybe it's 35, right? It's all of the cover call single stocks in it. And so it's one of those things that if you want to just dip your toe into the yield max world, YMAX is a great way to start. Has weekly distributions, and they're reflective of the amalgamation of all the distributions that those individual pieces have. So we love more fund of funds. We have interesting relationships like the Dorsey Wright funds, where people asked us, almost like you did, like, hey, can't you just do a fund where it's just the ones that are going to go up? Yeah, I don't know. I'm not going to pick the ones that go up. So we partner with a company like Dorsey Wright that specializes in momentum and projections. So we said, hey, here's our list. Tell us the 5 ones that you have the strongest conviction on. We put that in a fund, right? So that's FEAT and FIVY. FIVY is actually a hybrid half 60% the YieldMax version, 40% the long stock. So if you want more upside capture, great. Take a look at 5E. We do the inverses. I just mentioned that a minute ago, right? Like that's pretty unique. Nobody's doing that, right? Nobody's got an inverse. So, while we do see a lot of folks kind of copying or mimicking what we're doing in YieldMax, and that is a form of flattery, I know, and we're fine with that. The world breeds competition. I'm fine with that. No one's even touched those yet, right? So love that innovation. The target 12s, like you talked about institutions, right? They're comfortable with a QILD or a JPI, not as comfortable with an ULTY. That's okay. We've got Biggie, which is target 12. So it holds 50 of the largest market cap funds that have it just has a 12% distribution rate. So more digestible, right? So I think you'll see more and more innovation out of this team. The list of ideas on our board is vast, right? A lot of items there. We'll have to do another one of these and disclose those at that time. But so I'd say there's really more unique things. We do we have 3 zero DTE funds, right? Where we sell, calls at the open every day and on the indexes, right? So if you want an index version, we're at the point, and those, by the way, have weekly distributions. So an index version of YieldMax, right? So again, I think it's, when you ask what the future holds for YieldMax, I think it's more issuances, more of what's worked for us, but also more of innovation.
Now, thank you so much, Mr. J. Pestrichelli from YieldMax. I really appreciate your time and taking the time to provide a complete and full review of MSTY and ULTY, and shout out everybody on Reddit, on X, on YouTube, and everybody as well. If you are a YieldMax holder, shout out to you as well. Now, if you guys like this video, please give it a like because this cute puppy did, and check out our other interviews right here or right here. I love you guys so much. Crush it in the stock market and take it easy. Peace.